So quickly, we said our PV of deferred consideration will be equal to that 5.4 million. Yes, please. All right, so our PV of deferred consideration, they told us our consideration was going to be paid in 1 year's time. So that should be 5.4 million multiplied by 1.1 raised to the power minus 1. Everybody should be clear about that now, Abi.
I'm not clear about it too.
How we do, we're going to pay 5.4. Have you read the question yet? Because if you've not done, what you just did now is criminal.
No, I just looked at it. I was trying to ask you, Seth, before.
Okay, so ask.
And but just explain what we are doing now.
The 5.4 million will be paid in 1 year's time. So we want to bring it to present value because we are going to, what is important to us is what will be the value at the point of acquisition, not in 1 year's time. So in bringing it back to present value, we've discussed this over and over in different, and like I said, this thing is in a lot of standards where we talked about this. And to bring that 5.4 million to present value, then, oh, sorry, okay, I see why you're complaining. This is 8%.
Yeah, 8%. Mm-hmm.
Oh, so if that's why you're complaining, then you're a genius. So that's supposed to be 8%. So using that, so 5.4 multiplied by 1 of
no, I don't keep.
This is happening every day. All right, so let me change that 5.4 to 5,400 because we're working in thousands. Please don't be careless like me. Remember, we're working in thousands. So that should be 5,400. So that gives us 5,000. Right?
Which they've already given us in the book.
Which they've already given us. That's why I said that they had given us. So I'm just showing you in case they didn't give you. Because maybe at the original question, they didn't even give it. So what we'll do is to debit.
Okay, that's deferred.
Yes. So if we're back again, if we're back again, let me shift this one down.
5.4 multiplied by.
Let me shift this a little.
Under 900.
So for the cash, we're going to debit goodwill, and we're back to goodwill. Acquisition and so the discounted I wanted to use the discount part of the 8%. So if you was only 1 year. I thought you see this information. You see this financial statement. You see the question we publish. You see it in consolidation. The ability to discount and online is a very significant requirement as a one step 7 2 or in public or in consolidation. If you have any defect, I read that we can the same defect sometimes if they discount and then you online.
Yes. Thank you.
So please,
Sorry, could you repeat the question?
I'll show you. Just showing you where it came from.
Yeah.
Right now, so since the is at the amount so be equal and that's formula so that's when the online cost like very so that we so so if we go through the question, so the question is independent and record in Paladin financial. So that's immediate payment. It's record in financial. You're not it's not record because you're that you are. So our account now then we continue and pick everything. So like we said, and we have recorded on to goodwill. They said they've so that one is not going to go to anywhere because it's already
you go down small.
Down
Small.
All right, I'm
okay.
at the end of where we've copied to up to.
Yeah, thank you.
All right. So our goodwill now, we're already taking the 5,000. Then it's current liability now that has a credit of 5,000, but it also has another credit. It also has another credit of 400, right?
Yes.
Yeah.
So
Yes.
we can come and push, and then we have to group retained earnings. We have that 400. So those are the three things we need to do now. So we can go. I don't know. Let me just shift this one so that they will be on the same line. All right. So we have the current liability, two of them. We're taking both the 5,000 and the 400 to our current liability. I want to see how they did they write the financial statement? They had payables and bank separate. So we just create deferred consideration. So we'll go to our current liability. So that would force me now to start my whole statement of financial position. So I have assets, non-current assets. Of course, we'll have PPE certainly. So PPE. I don't know what else I have, so I'll just leave space. I'm sure I'll have goodwill definitely. I could just leave space for that. How did they give me current assets? Is it together or separate? So I'll just have my current. I'd rather have this shifted a little bit. All of this is when you have a lot of time. All right, so I'll just have my current assets, and then leave space for my current assets. Then I have equity and liabilities. So under that, I'll have equity. I could have started putting everything, but now that I have all of this, I can now start filling in. I'll soon need to fill everything in anyways. So that's non-current liability now. And then finally, I have my current liabilities. So under my current liabilities now, I can come and put my deferred consideration. So that is, was that work 6, Abi?
Yes.
So if you want, we can put 2 of them separately so that we'll just show that we know what we're doing, or so that it will be easy for people that are looking at this subsequently. So the 5,000 first, and then we also have the 400. So it's equal to that one too. So the 400 too is the liability. So that's fine. And so we have 5,400, and then we can go to our group retained earnings. That was the last thing we said. So we'll definitely have parents retained earnings. I think this space was too small. Parent retained earnings. Then share of PAP. So share of post-acquisition profit. which I will never write in full if I were in the exam. And then I leave one space, or I just no need to even leave the space. I know there was no impairment from what we read. So I can now have my unwinding cost, unwinding discount, whatever you want to call it. So unwinding cost, that's from work 6. And then I can go and I just shift it somewhere here. So it's equal to, and then we go and pick that figure. We want that figure to be negative because it's a cost, right? It's a debit to retained earnings. So let's just make sure that we get it so that it's easy to sum at the end. So that figure, and that's that. So we've done everything we're supposed to do. So if we think about it, we've taken the purchase consideration to goodwill. We said the cash has already been recorded, so we're not taking it. Then if we come down, we've taken the deferred consideration to goodwill. We've taken the current liability to current liability. That's our deferred consideration. We've also taken the finance cost to group retained earnings and charged it. And then we've also recognized the 400 as increasing the current liability. So with that, we're done with that part. Any question?
Can you go to group retained earnings?
All right. We have not done anything for group retained earnings except that.
I know you dropped 400 there.
Just 400 negative, yes.
Please leave it there, brothers.
All right, sir. That's the 400 for the unwinding cost that we just worked on.
Yeah,
All right.
yes. Yeah.
Sorry, excuse me.
Yes, please go ahead.
Sorry for taking you back. When you were trying to make clarification for that 80%,
Yes.
I think I went off, so I didn't get it.
Okay.
When I
all right.
joined back, you've already.
All right. Are you done, sir? So that I can explain the 80%. Okay. No, just go to your financial statement. On the investment part for the parent, they said the parent acquired 8 million shares. Is that right? 8 million shares of the subsidiary. Can you see that? To the financial statements, just the financial statements part.
Yeah, 8 million.
Okay.
8 million shares at $4 each.
Yes. How many shares does the subsidiary have? Go to the subsidiary's ordinary shares. How many shares does the subsidiary have?
That's 10,000.
10,000. That's 10 million. That's 10 million because it's at $1 each. It's at $1 each. So that's what we did. That's basically what we did. Nothing more than that. So we said 8 million out of 10 million is 80%.
Okay.
All right, so let me write that here. Parent acquired 8 million out of the subsidiaries. $10 million shares. So that's that.
Okay.
Yes, sir.
Hello, sir.
Yes, sir. I can hear you, sir.
The unwinding.
Yes.
Instead of using 8%,
yes, sir,
we can equally do 5.4 minus.
Yes, minus the 5 million.
5.
Yes. Yes.
Oh, okay.
Yes, absolutely. Absolutely.
Okay.
Absolutely. It's just that when you're doing it for 3 or 4 years, then you have to be comfortable with that 0.04. If not, it now starts getting kind of confusing. But if you subtract year N plus 1 from year N, you always get your unwinding cost. So the next year, subtract from the previous year, you always get your unwinding cost. All without N. It will always be like that.
Okay. This one is simpler because it's 1 year.
Yeah, but as no matter what, whether you do it as a subtraction or you do it as multiplying by 0.08 every year, it will still give you the same thing. And both of them are correct. Yes.
Okay, thank you.
All right, sir. Okay, so we are done with that. So we can go and continue our question.
Okay. 1 plus rate minus number of years 1.
Okay, so if we get there, we've already said that it acquired 25% of Augusta, paying 10 million cash. So we can come and do our work. I would have preferred that to be even be work fixed. So we can come to work 7 now. So work 7, our investment in associate. So our investment in associate, we can start our investment with associate with the cost of that investment. So cost at, wow, how time flies when you're having fun. So cost at 1st February, was that?
Yeah.
So 1st February 11. So they said 10 million, right?
Yeah.
So we're just going to call that 10,000. That's all. So that's the so if you will, you think about it. What we are doing now is we've debited this investment in associate and we've credited it out from, you'll see it in the financial statement of the parent. We want it to disappear from the financial statement. That's the 2 legs if you're looking for 2 legs. Do you get what I'm saying? It has now gone to the investment in associate. It's no longer an investment in the parent's book now. As by that ordinary investment, it is now an investment in associate. So that's what it's going to be. And then we'll do all the other adjustments, just like we talked about IS 28 equity method. So we're going to treat this investment in associate using the equity method based on the information we're going to get. So that's all we need for that. And we've already said that the associate is a 25% associate now, right? It's already in our note 1. So we're done with that. So we now go to the other parts and we start adding. So we go to our financial statements now and start adding. So we start from the beginning. So PPE, Abby. So we just go up and start adding everything. So PPE is cost.
PP's cost is 40,000 for Paladin.
So 40,000, yeah, and the other one.
The other one is 31.
And then the other one.
30.
So what do you think? I
No,
like the
we're
way
not adding
Josephine
the
lazily said 30. Please don't add
30,000.
associate. Your associate is only investment in associate.
Okay,
That's the work
yeah,
you're
yeah,
doing.
yeah.
It's equity
Yes.
method. You don't add for associate at all. You're not taking
Yeah,
25%
it's true.
of it, oh. You're just going to do your
Yeah.
You're just going to do your working
At
downstairs.
cost.
You're just going to do your working that we started. That investment in associate, we said
Yeah.
we plan for an investment in associate using the equity method, a 1-line consolidation. So we're just going to do what we need to do with the associate. That's all, nothing more. So when we come to that now, we'll see how to work on that. So nothing, you're only adding parent and subsidiary, nothing concern you with associate. You have nothing of associate except your investment in associate, which you will put under. All right, so what else do we have? What's the next thing?
Intangible.
So we have intangibles. So we put our intangibles there. So intangibles, I don't remember any information about intangibles. If there's none, we can just take it to the end of intangibles. I can't remember anything.
There's nothing.
Okay, so I'll take the risk and put it at the end. If there's anything, I will bring it back and adjust it. So 7.5, Abi?
But really, there's nothing actually.
Are you sure?
I can't remember. I can't
There's
remember
nothing
anything
about it.
So if there is, we'll carry it back and make the adjustment. No problem. Okay, so that's that. And then what's next? Investment. We've already accounted for the 32,000 in goodwill. We've already accounted for the 32,000 in goodwill, right?
Yes.
And we've already accounted for the 10,000 in investment in associate.
Yeah.
So 2 of them have disappeared. So that's fine. We have taken care of them. So we'll continue. What's next?
Current assets.
And before you jump to current assets, 2 things should bother you about non-current assets that you should put there. What and what?
Goodwill.
So what's the other one? What's the second one? You say it's not only goodwill.
Only goodwill I can
Investment in associates.
I wonder for how. The one that is looking at you now. That's the one. You like hard work, oh. The one that is looking at you now. Okay, so investment in associates too, because that's definitely something that is of concern to you. So that's our work 7, I think. That's what we called it. So when we
Yes.
finish, we'll
Okay.
bring it here. So goodwill work 3, and that's fine. So we move on. What's next?
There's something in intangible assets. Sir.
And we put intangible assets as 7.5.
No, there's a note on it.
So when we get there, I'll just adjust it. I don't care. It doesn't make any, even if I'm writing with biro and paper, if you cancel and bring it back and put it back, it's fine.
Okay. True.
I don't care. It doesn't bother me at all.
Relationship. 3 million.
All right, so let's go. Next.
Inventory.
They won't give you time
Inventory.
in the exam. So inventory, how much
There's a
inventory?
note.
Don't worry.
There's a note.
We always know that we can put inventory and we can take care of it later. Inventory will most likely be intra-group, unrealized profit kind of
Yes.
thing, which we expect. So that's fine. We can put it and make the adjustment for unrealized profit. Please, because this is not the forum, I've decided to skip it. In the beginning of the next class, we are going to talk about a mistake that we made yesterday, if you want to look at it like that. So something that we did not read properly, we'll make the adjustment for it in the next class. But let's focus on this one now. So inventory, parent, and subsidiary, please go ahead.
11.2
11.2. The mistake is not terminal, so don't worry.
8.4.
And what?
And 8.4.
8.4.
8.4.
All right. So
8.4.
what's next? Receivables, I guess.
Yes,
Yeah.
receivables.
So receivables, how much?
7.4.
7.53.
7.
5.3.
No, I didn't get it.
4 and
400.
5.3.
7,400 and 5,300. All right. Bank? Any bank?
Yeah.
Cash and receivable.
3.4.
So cash, how much?
3.4.
For who?
For parent.
Parent.
3,4.
There's banco for subsidiary.
No,
What
for
subsidiary?
associate. For
Associates.
Please, nothing concerns you with associates figures. Oh. Only parent and
I didn't say
subsidiary.
associate, though. I said subsidiary.
There's cash for
There's-
subsidiary?
No.
There is
No.
bank.
Jerry, we have.
There's no cash for subsidiary. Oh. Me, I'm
No, I
looking at
said
it.
there is bank.
Bank and cash are the same thing.
Yeah.
So,
That thing you're
That's-
looking at is overdraft.
That's later on now. That's overdraft. That's bad bank. So we'll not look at it here.
Yeah, it's true. Yeah,
Okay.
sorry, please.
So no problem. When we get there, fine. Okay, so equity now, ordinary shares. Ordinary shares, how much?
Ordinary share is 50. 50.
50,000.
Ordinary shares. It says how much?
50,000.
50,000 plus what?
10,000.
Plus what?
Plus,
You will not plus the 10,000 now. It's only for the
So I like the way you say you will not plus it. So when anybody that is not sure that this is a Nigerian talking, now the person is sure. You will not plus the 10,000. You will not plus the 10,000. You will not plus the 10,000. These people, before you put somebody in trouble, you will not plus the 10,000. So that we'll know that we know.
But I've heard.
So please don't plus the 10,000. Okay, so retained earnings. So retained earnings now we go to what?
25.
Where are we going to with retained earnings?
We'll go to workings now.
So we go to our parents' retained earnings. That's what we said before, Abi.
Yeah.
I can cheat in this
Yeah.
case. They start really liking doing us this thing. So they start liking
for the
doing us this thing. So for the year ended, they also give us another information, Abi. So we'll start with the parents'
Yes.
retained earnings. So we'll just do parents' retained earnings at. I don't know whether can we finish this thing. So let's try and see whether we can rush through. At what's that? At 1st October 10, Abi.
2010.
So
Yes.
2010.
10. My favorite day of the year. Is what? How much?
Whose day is it?
700.
700.
25,700. 25,700. And then, of course, then for the year ended for the year. So for the year is how much? 9,2. All right, so we have that. So when we come back, we'll just start with our subsidiary so that we can do the fair value of net assets part. So we'll just do that. So let's move on. What's next?
For the subsidiary now.
Deferred tax. No, I will leave that one. So let's just get to the
Okay.
end. So deferred tax now. All right.
Mm,
So deferred tax. How much is deferred tax? Yes, go ahead. We're adding all the parent and subsidiary assets and liabilities.
15,000.
So 15,000 plus
So
what?
deferred tax is 15,000 plus 8,000.
Plus
and
8,000.
eight.
Who's next?
8,000.
What's next?
Next is bank.
Current
So,
So
liability.
overdraft, Abi.
Current liabilities.
So bank.
Bank liability.
Yeah.
Bank, how much?
Yes.
How much?
2.5.
2.5.
Thank you, but I don't drink fast.